Morning, Tim.
Morning, Fred. How are you today?
Good, good. It's Friday. Thank goodness. Yeah. It's been a
Tough
long,
week, huh?
it's been a long week. Yeah, a lot going
Yeah,
on in the world.
it's exhausting. My neck hurts
Hmm. Yeah,
from the way this thing's been spinning around. I mean, the dock strike was settled, and
yeah,
at least it's settled until January.
yeah,
60% increase. I'd have to call that inflationary, wouldn't you?
yeah. I mean,
Yeah,
that's what we've been talking about. The idea that we're going to see wage inflation popping in. You
yeah,
know, I know we've certainly been seeing on the agricultural side and everything else, but wage inflation, 60% raises, even though it's over 8 years or whatever the number they were talking about, it still translates into big numbers.
yeah. And they're trying to catch up from the last 3.5 years where they've been operating on a 6-year contract.
Yeah.
I think, we used to talk about cost push versus demand pull inflation.
Hmm.
Cost push is clearly here.
Yeah.
Demand pull, I guess if you believe the payroll numbers that we just saw today,
Yeah, very big numbers. Twice
I don't know that
market
I don't know that
inflation.
I believe them. You know,
They'll be, yeah,
you got to wait
they'll
for
be,
the revisions to find out whether or not how far they overstated the gains. And the
yeah,
other thing that I haven't delved into in a long time is the labor participation rate. I mean, they're talking about the amount of people who are out there looking for jobs, and these numbers, if believed, say that most people who look for a job can find one. But what about the people that dropped out of the workforce and are not looking anymore? I don't know where that is. Um,
that's always
but
been the difference between the non-farm payroll number and the unemployment number. Two different gauges of where that, how that affects the economy and where those people are standing.
yeah,
Yeah,
getting back to the dock strike, the big issue there, I think, is not the absolute number of wages, but their position towards what's the word I'm looking for towards improvement in technology. I mean, before you were born, and we lived in Brooklyn, or
yeah,
basically when you were just a small kid, the Brooklyn docks had gone on strike in a big way because they would not automate and go to containerized shipping. And that was their position, and the Longshoremen's Union didn't like the fact that ships came in sealed containers, cargo, for a
like you
lot of
said the
reasons.
other day, nothing fell off the truck, right?
Primarily, that was a big reason, I'm sure. But their argument was basically it was the technology was going to put people out of work. That would take less people to handle a container. You got one crane operator where 16 guys would unload
Yeah,
a ship. It strikes me that what they tried to do was fight it, and the other piers took over. The Jersey
hmm,
piers were much more
they were.
technologically advanced. They went containerized, and they pulled so much cargo from shipping out into New Jersey that finally the longshoremen had to relent, and they gave up. And I think that's what they're facing right now. And the fact that they managed to get a 60% raise and they're going to renegotiate in January, presumably they're going to renegotiate the technology issues. That kind of works in two ways. The rank and file lose jobs, but so they're easy. They say, well, okay, we're not going to lay off. We'll just change the job structure through attrition.
Hmm.
As people retire, we just won't replace them, and the technology will pick up the slack. That's how you deal with the rank and file. But it hurts the union because their membership goes down, their dues
Yeah,
go down. So the union and the rank and file are in two different positions on this, and
right.
that's something to watch in January where that plays out.
Yeah, the unions have always, they're just looking to protect themselves.
Yeah,
Their power base disappears over time.
yeah.
Yeah,
Unless their membership, the smaller membership, reduces their political power,
hmm,
and that's really where the strength lies.
yeah,
Particularly in an election year.
yeah.
So that's that as far as the
Yeah,
strike
but at least
goes.
that's out of the way for now. As you say, we got 3 more months to deal with it.
Yeah,
And,
and an election. So it's Friday. And I don't imagine a lot of people are going to go home short gold or crude oil, judging from where the Israelis are with Iran.
Scary videos I'm seeing that Syria, Lebanon, the whole Middle East is a powder keg, and I don't think anything's priced in. I don't think.
Well, it's hard to say. Crude oil has been dropping, and it was at attractive levels, at least if you're a chartist, before the hostilities. But now, could go anywhere. So those options, I think the VIX is something around 19. It's still reasonably cheap in wartime.
Yeah.
Yeah.
Yeah,
So
I'm looking at XLE, and where I think the contract highs were at 98. What is it, 90, 93 now, 95?
got up to 92 and 93, I think. I got the 90
Yeah.
calls. So.
And contract highs are at 98. Why couldn't that be 110? You know, why couldn't we have a 20% move at XLE if something crazy does happen in the Middle East?
Yeah.
And the newsletter we read every day says, I have a life hedge. If the world falls to pieces, I want to make money. If the world falls to
Yeah,
pieces,
he's got
it's
an
that part
interesting
of my life.
perspective. He's got interesting perspective on that. But I think, to me, the interesting part of all of that is we haven't replaced the strategic oil reserves yet. So it's a big piece of demand just lurking under this market,
Right.
waiting, it's a stop loss essentially, sitting underneath XLA. That said, if you believe these numbers, that's bullish for oil. Not to mention the geopolitical risk, which, as you point out, doesn't really seem to be priced in.
Right.
I think commodities as a whole are ready for a cost push. The numbers say demand pull, but I don't know that that's
We've
there.
been talking about all of these episodes that we do touch on the fact that inflation is not going away. The Fed was a little premature in going 50 basis points when they did, and it's going to be very tough for them to reverse that. And I think they're just open the flames again.
I mean, that's the bigger point here. We've got more than one generation, maybe two generations of traders. We touched on this point previously, that dealt with a Fed that had credibility.
Mm-hmm.
And you got all these knee-jerk reactions. For a while, they had this risk-on, risk-off light that people traded with. Bad news is bad news. Bad news is good news. When you have a Fed that doesn't enjoy the credibility of the marketplace, then bad news is indeed bad news and not good news. We see bad inflation numbers, for example, and immediately the reaction is, well, interest rates are going to go up to respond to this, and the Fed's going to respond to it, and therefore we take the following positions. But if you don't have a belief that the Fed will respond to it, that you have a helicopter Ben Fed,
Just pour money on it. Yeah.
yeah, then there, and that's I guess that's people explain that away now by saying the Fed is politicized or the Fed's not politicized. We're viewing it through that prism these days. But this Fed lost its credibility 2 years ago with the transitory remarks and not responding to clear inflationary pressures, thinking they were temporary, and had to really go some to gain credibility again, take these rates up and respond.
The Fed that I've dealt with, and I'm discounting the Volcker Fed, but Greenspan to a large degree followed the market. He led away. He passed on his comments. You had to parse his words to really find out. But when the market moved in a direction, the Fed accommodated. Last 2 years ago, as you say, the market moved in a direction and the Fed didn't buy it, didn't believe it.
Yeah.
And that's when it began to lose credibility. So
Yeah.
inflation-
Well, I think they regained it though, with the sharp hikes. I mean, he took these rates up faster and farther than any Fed I've ever seen. So he obviously saw the writing on the wall, and the market had lost complete faith in not just the Fed but the Treasury too. I don't think
Right.
this market's comfortable with Yellen in manner. But that said, 50 basis points in the face of these employment numbers is very hard to justify.
Right.
And this market now, I mean, the first thing they did is they took the Dow up 250 points, and last I looked at it, it was about flat. They gave away most of those gains. It's going to be hard for the Fed to justify the 50 basis points that this market had already anticipated.
Yeah.
So I think that's where we are. You got huge geopolitical risk, which is only increasing moment to moment. So every Friday, you're going to see demand for gold, I guess, although today you really didn't see that so much. Although gold lost big, was off 20 before the opening, and last time I looked, it was off 8. So it had gotten back a lot of those losses. So you'll see oil under pressure for the geopolitical risk, and gold.
Upward pressure, oil under upward pressure.
Yes, yeah, that's what I meant. I'm sorry. Okay,
Yeah,
so
I agree with that. You know, the core investment strategy to me is you got to be long gold, you got to be long oil, and you got to be long inflationary.
Expectations.
Right. So that's short bonds. You know, we've said this a number of times, not just on these podcasts, but over the years. The Fed controls the front end; they don't control the back end. So the more that they ease in the front, the more trouble that the back end's going to have. And I talk to people in the real estate markets, and they keep asking me when are mortgage rates going to come down. And I don't know how much they're going to come down from here. I think the problem is where's the 20-year going?
Well, the only thing I would add to that is the Fed does try to control the back end when it expands its balance sheet and goes out and buy longer-term securities.
Yeah.
But and you've seen that. I mean, the Fed balance sheet, they keep talking about shrinking its balance sheet. Doesn't look like it's shrinking to me.
No.
And even though he uses 50 basis points, the balance sheet doesn't shrink. And I would call that easing through the back door. And this Fed is doing that. This is an easier Fed. It's hard to refute that.
Right.
So the position is buy the curve steepener, expect inflationary expectations to rise, and look for inflationary pressures on your positions.
Yeah, these are the themes we've been talking about and fearing for the longest time.
Yeah.
I've basically had gold and oil in the portfolio for a long time.
Okay, we got an election coming up, and I wouldn't be surprised to see people lighten up on their positions. They got big gains to take and protect. And in the event that you do get a Harris win, depending on what happens in the Senate and the House, tax positions are really going to change the whole game.
Yeah, I talked I guess it was last week, we were talking about the health care. And regardless of who gets in, whether it's Trump or Harris, the healthcare sector would be put under pressure. Trump through RFK, if he's part of the administration, he's going to beat up the pharmaceutical companies, and Harris is going to try and make drugs cheaper. And I was talking to our mutual friend down in North Carolina yesterday, and his point was, yeah, but they may not go after the drug companies, they may go after the insurance companies to accept some of these, weight loss drugs and diabetes drugs, and healthcare is going to continue to motor on.
Yeah.
So I don't know. I'm of two minds now.
Yeah, preventive maintenance is probably a better way to
They
go.
pressure the insurance companies, so an $800 drug or a $2,000, obesity drug that they get the insurance company to sign off on for, a couple of $100 makes it a big difference.
Okay, well, we go on another week. We'll see where we
Yeah.
go over the weekend and hope for world peace.
Yeah, exactly.
All right, talk to
All
you
right,
Monday.
have a great Friday.
Take care.
All right, bye.